7 countries moving to Canada after Trump's tariffs. Why is the US losing massive global power? After Trump's tariffs of 25 to 155% on everything from autos to agriculture in early 2025, 7 major trading partners, Germany, Denmark, South Korea, France, Mexico, Australia, and Brazil, started pulling their deals, investments, and alliances out of the United States. They didn't pivot to China or the EU. Instead, they turned to Canada. The reason? Canada's stable regulatory environment and open trade policies offered a clear alternative as U.S. economic leadership faltered. So why are these countries now seeing Canada as their preferred partner? And what does this shift mean for America's place in the world? The answer starts with Germany. Germany's auto industry faced a turning point in January 2025 when the United States imposed a 25% tariff on German-made vehicles and auto parts. The impact was immediate and severe. Sommerch GmbH, a major supplier, saw 2,500 jobs threatened almost overnight as orders from the US vanished. Production in Wolfsburg slowed sharply, and warehouses filled with unsold inventory. The shock rippled through the sector, forcing German manufacturers to act fast to avoid a full-blown crisis. Instead of caving to US pressure, Germany moved quickly. On February 14, 2025, German officials signed a supplemental trade protocol with Canada. This agreement set up tariff-free quotas for German auto parts, opening the door to $10 billion in duty-free exports each year. German factories responded by rerouting 70% of their January production to Ontario assembly plants. Engineers in Bavaria overhauled shipping schedules, loading engine blocks for Toronto instead of Detroit. The shift was both immediate and strategic, aimed at keeping assembly lines running and jobs intact. The results were clear in Canada's auto sector. GM Canada's Oshawa plant brought back 350 assembly line workers to handle the influx of German steering modules. In Hamilton, the main automotive logistics hub added 200 drivers and warehouse staff to manage the new cross-border freight. Canada's auto industry grew 12% in the first quarter of 2025, directly benefiting from the realignment. What was intended as a blow to Germany ended up fueling growth north of the border. Germany's pivot didn't stop with cars. Intercon, a leading wind turbine manufacturer, signed a $1.1 billion memorandum with Canada's largest hydroelectric operator. This deal allowed turbine components to flow duty-free into Canadian ports for the rest of 2025, sidestepping US tariffs. For German industry, it wasn't just about weathering Trump's trade moves. It was about building new, stable partnerships outside of US influence. The US tariffs were supposed to force Germany back to the negotiating table. Instead, they pushed German industry to find new markets and partners. Canada's open trade environment and robust infrastructure made it the obvious choice. The lesson was clear. When one door closes, another opens, especially for countries willing to adapt quickly. Germany's response set a template for others. As the dust settled, it became clear that the realignment wasn't limited to the auto sector or to Germany alone. Other countries watched closely, and some faced even harsher tariffs. Denmark's experience would show just how far these shifts could go. Denmark's green energy sector faced a crisis in early 2025 when the US imposed a 30% tariff on Danish wind turbines and solar modules. Factories in Esbjerg and Aalborg lost $800 million in US contracts almost overnight. Industry analysts said Denmark would have to take the hit or negotiate, but the government moved fast. By April 1st, Denmark had signed a $1.5 billion green technology partnership with Canada, rerouting wind turbines and solar modules to Nova Scotia and Saskatchewan. The US was out, Canada was in. This agreement gave Danish manufacturers a lifeline. Orders that were supposed to go to Texas and California now shipped to Canadian provinces instead. Danish Energy Minister Lars Agard called it a necessary pivot in a press conference. Danish plants kept 900 jobs that would have disappeared without the Canadian deal. Across Nova Scotia and Saskatchewan, 1,100 new positions opened up in the renewable sector as Canadian firms scrambled to install and maintain the new equipment. In Estevan, Saskatchewan, the local facility went from 200 employees to 550 in just 3 months. Nova Scotia's grid operators hired hundreds of new technicians to handle the surge in clean energy projects. The financial turnaround was immediate. Denmark's energy agency reported that wind turbine exports to Canada jumped from $500 million in the first quarter of 2024 to $1.2 billion by April 2025, a 65% increase in just a year. Halifax, Canada's main Atlantic port, saw record weekly shipments of Danish equipment. The sudden redirection of trade was visible not just in numbers, but in the pace of construction and new jobs on both sides of the Atlantic. For Denmark, this wasn't just about survival. The pivot proved that countries could bypass US tariffs entirely by partnering with Canada. The US wanted to protect its domestic energy sector, but the real result was a stronger Canadian competitor and a Danish industry that didn't miss a beat. Saskatchewan's wind power share jumped from 28% to 42% of the grid. Nova Scotia moved its renewable targets up by 5 years because of the influx of Danish turbines. Denmark's energy pivot proved tariffs can backfire, but what happened when a 20% EV tariff hit South Korea? South Korea's electric vehicle industry didn't wait for the fallout. In February 2025, the US imposed a 20% tariff on EV battery components, putting 3,000 manufacturing jobs at risk and threatening to derail the export-driven growth of companies like LG Chem and Samsung SDI. The American market dried up overnight. Instead of absorbing the losses, South Korean firms acted quickly. By March 20th, LG Chem and Samsung SDI signed a $1.7 billion supply contract with Northvolt Canada, redirecting 500,000 battery modules to Ontario's assembly corridor. Shipments that once headed for California were now bound for Windsor and London. This pivot kept the South Korean gigafactories running at 95% capacity, preserving those 3,000 jobs. Production lines didn't shut down. Instead, they shifted focus, and shipping manifests reflected the change. Windsor's Northvolt facility saw a surge in arrivals, 45 container ships in May alone, a record for the plant. The Canadian EV sector absorbed the redirected supply, and Northvolt's Windsor workforce nearly doubled, growing from 800 to 1,500 employees in just 4 months. The US tariffs, meant to protect domestic jobs, ended up fueling Canadian industry and strengthening the supply chain north of the border. The consequences went beyond immediate job numbers. South Korea's trade ministry revised its long-term plans, moving away from US dependency. Hyundai announced its next EV plant would be built in Quebec. Kia shifted its North American R&D center to British Columbia. Samsung SDI increased its sourcing of lithium from Canadian mines, jumping from 12% to 40% post-tariff. LG Chem chose Manitoba for its new cathode factory, passing over Michigan. The US lost its place at the center of the EV supply chain. Canada stepped in, and South Korea adapted. Financial reports show the scale of the change. South Korean EV exports to Canada rose from $900 million in 2024 to $2.3 billion today, while exports to the US dropped by 2/3. The pattern was set. American tariffs didn't bring manufacturers back, they pushed them away. South Korea's EV pivot set the stage. Next, see how France tackled a 30% hydrogen tariff. France's hydrogen sector faced a serious setback in February 2025 when the US imposed a 30% tariff on hydrogen electrolyzers. French manufacturers suddenly found hundreds of millions in clean energy exports priced out of the American market. Factories in Lyon and Marseille faced immediate production slowdowns as US clients canceled orders. The pressure was on. Industry analysts expected France to accept lower profits or withdraw from North America altogether. That didn't happen. On April 3rd, France and Canada announced a $1.2 billion joint venture that changed the equation entirely. Instead of shipping to Texas and California, French companies rerouted their technology to Canada. A leading electrolyzer manufacturer redirected $800 million worth of 2-megawatt units to Quebec and Ontario, supplying the growing Canadian hydrogen market. At the same time, a turbine producer near Paris dropped plans for a Michigan facility and committed $400 million to build a wind farm off Nova Scotia. Shipping records from April show a significant redirection of French hydrogen technology, with Montreal and Ontario ports receiving the bulk of these new shipments. The joint venture stabilized the French clean energy sector. It preserved 1,000 jobs in France that would have been lost to cancelled US contracts. In Canada, it created 850 new positions, 300 in Quebec's hydrogen sector, 400 in Ontario's clean energy grid, and 150 in Nova Scotia's wind projects. Quebec rolled out 3 new hydrogen fueling stations by June. Ontario fast-tracked a $300 million electrolyzer factory permit in Thunder Bay. Canada's hydrogen infrastructure investment surged 22% after the deal, a direct result of the partnership. Financial data makes the shift clear. French hydrogen exports to Canada tripled from $200 million in 2024 to $600 million today. At the same time, US-bound shipments fell by 80%. The tariffs didn't make American hydrogen more competitive. They just handed the advantage to Canada. French companies now see Canada as their main North American hub, with plans to double investments by 2027. France's energy ministry updated its guidelines in May, designating Canada as its preferred North American partner for clean energy. 3 major French research centers opened Canadian branches. The US assumed France needed their market. Canada showed they didn't. The effects of this shift didn't go unnoticed. Mexico's response to the US tariffs was immediate and decisive. When the US imposed a 35% tariff on Mexican auto parts in March 2025, the foundation of North American supply chains shifted overnight. Mexican manufacturers faced a sudden roadblock. But instead of waiting for negotiations, Mexico's trade ministry moved ahead with a comprehensive logistics agreement with Canada on April 8th. This deal rerouted 40% of Mexico's northbound freight through Canadian ports and rail hubs, creating a new path for goods that bypassed the US entirely. The numbers tell the story. Before the tariffs, 78% of Mexico's exports went to the United States. By June 2025, that figure dropped to 55%. At the same time, trade volumes between Mexico and Canada surged by 37%. CN Rail responded by adding 25 new weekly trains between Montreal and Mexico City, and the Port of Vancouver handled 40,000 more Mexican containers in the second quarter compared to the previous year. Mexico picked Canada for clear reasons. First, Canada's trade policy is stable. It doesn't swing with every election. Second, Canadian infrastructure was ready to absorb redirected shipments, with ports and railways able to handle the increase when U.S. routes became tangled in tariffs. Third, leadership mattered. Mark Carney's experience as a central banker gave Mexico confidence that Canada could be a reliable long-term partner. Mexican Finance Minister Rogelio Ramirez mentioned that the new alliance is a predictable partnership in unpredictable times. Canada didn't just gain more freight. Toronto's financial sector secured $600 million in new trade finance deals. Manitoba's Centerm Port increased its workforce by 15% to handle the extra Mexican cargo. Canada also gained control over alternative supply routes for North America. When the U.S. later imposed tariffs on Chinese goods, Mexico and Canada negotiated as a bloc, cutting the U.S. out of key talks. The shift in automotive supply chains was especially stark. Mexican factories started shipping unfinished vehicles to Ontario for final assembly, not Michigan. This move kept 8,000 Mexican auto jobs that would have been lost, while Canada added 3,200 new manufacturing positions. Cross-border truck traffic at the Detroit-Windsor Bridge dropped 22% as goods moved through Canadian routes instead. Mexico's trade ministry isn't treating this as a short-term fix. New guidelines prioritize Canadian partnerships through 2030, and 3 major Mexican banks opened Toronto offices in May 2025 to handle the growing volume of cross-border business. What began as a reaction to tariffs has become a strategic realignment. Mexico now sees Canada as its most reliable North American partner. The U.S. wanted to force jobs back home. Instead, they pushed Mexico and Canada closer together, creating a supply chain that doesn't depend on the U.S. at all. This realignment didn't go unnoticed. Other countries facing their own tariffs started to rethink their alliances. Brazil's experience with U.S. tariffs in 2025 shows how quickly trade alliances can shift when the pressure is on. In March, the U.S. government imposed a 25% tariff on Brazilian beef, soy, and ethanol, cutting off access to a market worth billions and sending shockwaves through Brazil's agricultural sector. Ranchers in Mato Grosso and Paraná faced a sudden loss of contracts. The beef industry alone stood to lose $1.2 billion in annual exports. Soy shipments, usually bound for Gulf Coast ports, were left sitting in silos. Ethanol producers saw $200 million in contracts canceled overnight. The U.S. tariffs were supposed to force Brazil to accept new terms. Instead, Brazil's trade ministry called Ottawa. On March 28th, Brazil and Canada signed a comprehensive agricultural trade agreement. The deal redirected $1.2 billion in Brazilian beef exports and $600 million in soy to Canadian buyers, along with $200 million in ethanol contracts for Canadian refineries. Brazilian ranchers who would have faced layoffs kept their operations running. 5,000 ranch jobs were preserved across Brazil, and the new flow of goods required Canadian meat processors to add 400 positions in Alberta and Ontario. Canadian ports in Vancouver and Montreal reported a 31% jump in Brazilian agricultural shipments. The supply chain didn't just recover, it grew. Canada's appeal was clear. The trade environment was stable and the infrastructure was ready for more imports. Canadian food processors invested in new equipment to handle the surge in Brazilian beef and soy. Alberta's main meatpacking plant expanded its workforce by 250. Ontario's ethanol refineries added 200 new jobs to process the redirected Brazilian ethanol. Canadian grocery shelves, usually stocked with U.S. beef, now featured Brazilian brands. The change happened fast, and it was visible everywhere from supermarket coolers to rail yards. Financially, the impact was immediate. Brazil's agricultural exports to Canada more than doubled, reaching $2 billion. Canadian importers secured long-term contracts with Brazilian suppliers, locking in prices and supply for years. The U.S. lost its leverage, and Brazil gained a new, stable market. The move also gave Canada more influence over global food supply chains, and Brazilian exporters found a partner that didn't threaten them with sudden policy reversals. This shift in agricultural trade set a new precedent. Countries facing American tariffs no longer saw the U.S. as their only option. Canada became the logical alternative, offering predictable policies and open markets. The pattern was clear. When tariffs go up in Washington, new trade routes open up through Ottawa. Brazil's pivot to Canada didn't just help ranchers and farmers, it changed how countries think about their trade partners. And as the next wave of tariffs hit green energy sectors, the same strategy started to play out on an even larger scale. Australia faced a turning point in March 2025 when the United States slapped a 25% tariff on critical minerals and metals. This hit Australia's mining sector fast. Iron ore, lithium, and rare earth exports to the US became too expensive to compete. Mining companies in Western Australia and Queensland started looking for new buyers. The US tariffs didn't just threaten profits, they put thousands of jobs at risk and left shipments stranded at port. Instead of waiting for things to get worse, Australia's government moved quickly. On March 12th, the Northern Stars Initiative with Canada, a $3.5 billion deal that changed the entire direction of trade. The agreement rerouted Australian ore shipments away from U.S. ports and straight to Vancouver and Thunder Bay. Canadian steel mills and battery manufacturers got first access to Australian minerals, and in exchange, Australia locked in stable demand for its resources. The numbers tell the story. By June, 400 new jobs opened up at Canadian ports just to handle the surge in Australian shipments. One of the biggest moves came with lithium. Instead of shipping battery-grade lithium to US gigafactories, Australian mining firms entered a joint venture to send $850 million worth of lithium directly to Welland, Ontario. That deal alone preserved 2,100 mining jobs in Western Australia. Canadian battery plants expanded hiring to keep up with the new supply, and Ontario's electric vehicle sector saw a boost in both production and exports. The US lost out on the minerals it needed for its own green transition, while Canada stepped in and reaped the benefits. The impact didn't stop at minerals and metals. Australian mining equipment makers started shipping machinery to Canada, not Texas. Canadian railroads invested in new infrastructure to move ore from Vancouver east to manufacturing hubs. Australian mining executives started flying to Toronto and Montreal for meetings instead of New York. The trade relationship deepened, and both countries saw the payoff in jobs, investment, and stable supply chains. Trade data makes it clear. The Port of Vancouver set new records for monthly ore shipments. Thunder Bay, usually quiet in the spring, became a hub for unloading Australian metals. The US thought tariffs would force Australia to negotiate on Washington's terms. Instead, the tariffs forced Australia to build a new partnership with Canada, one that isn't subject to the political swings in the US. Every time the US puts up a new barrier, another major economy finds a way around it, and Canada is the one opening the door. The pattern holds across industries, whether it's autos, agriculture, green energy, or minerals. The US keeps pushing allies away, and Canada keeps picking them up. This year's US tariffs were supposed to help American industries, but the numbers tell a different story. Germany rerouted $8.2 billion in auto parts. Denmark's wind exports to Canada surged 65%. South Korea doubled EV battery capacity in Ontario. France secured $1.2 billion in hydrogen deals. Mexico shifted 40% of its freight north. Australia locked in a $3.5 billion minerals pact, and Brazil clinched $2 billion in beef and soy contracts. Canada's auto sector grew 12%, wind capacity jumped, and new supply chains formed almost overnight. Which country's pivot surprised you the most? Tell me in the comments, and hit subscribe if you want to keep tracking Canada's rise in global trade.